Hello, welcome, Jared. Back to episode 2 of Your Wealth Playbook.
Welcome. Good morning.
Not the Wealth Playbook, Your Wealth Playbook. I think we have got that wrong in the first couple of episodes, but it's definitely Your Wealth Playbook. Something that you and I are big on recently that we'll probably start each sort of podcast with. Some people may turn off after this, but a little bit of philosophy that we love to go through, and it's been helping me, it's been a guiding light for me recently, that I've sort of stumbled across, and it's been helping me with day-to-day life. And there's a point there, I've got young children. Hazley, my daughter, was sick during the night, and we were up, all hours of the night. Many people have the same sort of scenario. And I didn't feel like getting up for work. The alarm goes off at 3:30, not what I wanted to do. I'd probably had 2 or 3 hours worth of sleep, but it was the challenge and reframe my mindset around I don't have to get up and I don't have to look after these children. I get to, and it's a privilege for me each and every day. And when you can remind yourself that it is actually a privilege to do the things that we do, my mindset shifted and I jumped out of bed and away I go, and everything I do is for them. But it's that little mindset shift. Instead of saying I have to do these things, it's I get to, and it was such a big benefit for me. So kick off the podcast with that. But in essence, we've got some exciting news. We're in the last couple of episodes that we will record in a little white-walled office because Your Wealth Playbook is moving to a new home.
We're upgrading.
Yeah. Interesting though, getting some office space, having this as a more permanent setup for what we want to do, not only now, but into the future, to continue bringing great content around how you continue to build wealth, something that we're both passionate on, helping people. But interesting, I thought, was a good topic for today, is how we can structure not only the commercial lease, but also the ownership of that property, commercial property, so that it doesn't impact your family or my family moving forward. And the best structure to do so, structures, is what we're going to talk through, specifically around holding structures for property. Give me a little rundown.
What we're going to look at is non-trading entities. So whether they're proprietary limited companies, trusts, it's a legal structure to hold an asset. Important for the average punter, you and I. What are our goals as we move forward? We want to make sure that they're unaffected. So by holding something in personal names and owning together would obviously massively affect that due to the lending on it, the outgoings of it. We're going to have a look at that in a bit deeper detail and how that does affect you under a personal name. But the ability from a legal sense, from a lending sense, to have it, and why it makes sense for certain individuals in a trust or in a proprietary limited company, and what are the benefits, moving parts that then helps moving forward.
Yeah, I think that's big because a lot of businesses will have 2 directors. And even if you are brothers, if you are family members that you go into business with, generally you've got different family goals, and you don't ever want what you're doing in business to impact that. Because I've definitely had it where I've got a lot of business goals and pouring a lot of money into the business and got the business going, but then my wife is going, Kerrod, I want a family home as well. When's this coming? And you don't want to impact the 2, especially if the families, if you do have 2 directors, could be multiple directors. Setting up, non-trading entities to hold property can be really beneficial, especially if you can get them to a point where they're neutrally geared and or positively geared, that you've then got the ability, with an accountant's letter, subject to great accountant's advice, that you can have a letter saying that standalone services itself, and it doesn't impact the borrowing capacity of the directors.
Yeah, and that planning bit's obviously the crucial bit when it comes into it, is making sure that you've got an accountant that understands what your objectives are, that there's moving parts within your personal life and your professional life, and that they have the ability to do that. More importantly, what they need to give them the confidence to write that letter. How are they going to make sure that it can meet its own commitments? Is that something they look at just the loan repayments based on the loan contract versus the income that it's getting? Is it the loan repayments plus expenses like a profit and loss versus the income that it's getting to make sure that it's trading profitably? Understanding that at the start is critical, because you don't want to go in with an assumption that, hey, they're going to work it out using this methodology that I've used, that it passes by a couple of bucks, they're going to sign off on it. It comes time that the letter is due, you go in to get it and they say, no, that's not what we do. That's maybe what your friend's accountant does. We're completely different. They'll also potentially be, that they might have to verify it through, going through your tax return. Others might be happy to look at it, interim throughout the financial year and look at just the lease statement that you've got. That's also where it's a little bit easier when it is something that is done, through a company that's, you're the director of. You can, make those lease terms, in line with what it needs to be from the start. Looking at other asset classes like residential property, it's obviously a little bit harder. It may take a little bit longer. If you're looking at things there that, you're buying a property, very rarely will you be able to buy a property and it'll be able to meet its own commitments from day one, depending on how they're looking at it.
Important, the planning process and stage of that to get everyone online, making sure that you've got one accountant that understands your goals, but two, what you're trying to do moving forward so that it can be a standalone entity. Funny you talk about making sure that it can service itself. If we break that down really, really simply, servicing itself, what are we talking about there? If we go and purchase $1 million commercial property, let's say the debt, we've had to put in a 20% deposit, so the debt's $800,000. To service an $800,000 is going to be an expense to that non-trading entity. Therefore, the income that it receives, likely from the rent or the tenant, works well if you're the business that's paying the rent there, and it offsets itself. That's what you're talking about with a commercial property that, let's say that it's cost you $60,000 in the year for the interest payments on $800,000. If the rent's $60,000 a year, naturally there's some more expenses and things like that, but naturally it can be as simple as that. If we break it down, $60,000 worth of expenses, $60,000 worth of rent, which is income for that non-trading entity. It holds the property. We square the ledger away and say this services itself, this debt services itself. Anything above that, income above that, let's say that the rent was $70,000 and the expenses were only $60,000. In a non-trading entity, what happens to that additional income?
So the income there, we distribute among our beneficiaries, depending on what sort of non-trading entity we're looking at. It might be a profit distribution if it's a proprietary limited company, but that's when it starts to drive you an income stream from that. So as things move forward, be it commercial or residential property, ultimately you want to get to that point where it is making you money, because then you can use that income to go and buy your next one.
The best of both worlds.
Yeah, exactly right.
And
that's where you got to look at it long term, where things like that happen. It's not something that's going to happen overnight, but where we are at the moment in an interest rate cycle, if we see a couple of rate cuts and we review this episode, say in 12 months' time, and see where that sits, that's potentially a position that we'd see this in, is that, if we can see a couple of rate cuts, that lease remains unchanged, the outgoings drop because of it. Puts you in an environment that it is going to start to draw an income from it.
Yep. Building wealth, plus creating an income stream, plus it allows you to go and leverage that, especially if there's a little bit of equity in there, but it allows you to go and leverage additional income to go and go again, to continue building wealth. I think that's the Goldilocks scenario that we're all looking for. As you mentioned, it's a little bit harder off the bat if you're going to go with a domestic property or a residential property. Generally, it's because the rental income isn't there to service, an 80% loan. You just, especially where interest rates are at the moment, it won't have that capacity to do so. Commercial property, you're probably getting close because rental yields are in between sort of 5.5% to 6%. They can be sort of anywhere between 5.5% and 7%, depending on what type of asset it is. But also with commercial property, it's the net rent. So the tenant pays for all the expenses. So what actually comes through to the owner, or in this case, a non-trading entity, is pure rent. So weighing it off, cost can be quite a nice way to build wealth if you've got commercial property. But if we're looking at a residential property, because this is a scenario that a couple of clients of ours do have as well, non-trading entities for residential property, how would you go about getting that to square the ledger? How would you go about getting that? What's the best option to basically go again? How do you square the ledger?
Look, if you've got a family that's looking at this and say that their goal is, they come in, they sit down, say, look, Kerrod, in 20 years we want to retire. We want to have, 5 separate properties that are paying us an income. Our goal to get there is that we want to accumulate 15 over that period of time, and we're going to liquidate 10 to leave ourselves with those 5 completely debt-free. Somebody's borrowing capacity, the average family household is not going to be able to buy 15 properties over that period of time, regardless how much rent it gets. Every time that rental is added on, most banks will use between sort of 70 to 90% of that rental income. Couple that on with the way that they look at lending through lenders. You're looking at borrowing, say at 6%, they'll chuck a buffer of 3% on there. So they're looking at 9%. So each time you buy, your borrowing capacity is going to be diminished. Let's use an average of say 5 to 6 times a household income. Say a household income is $200,000. Borrowing capacity, give or take, is going to be anywhere from about 1 to 1.2 million. If you're then looking at that within an entity like this, where we can say, okay, the borrowing capacity might be a little bit lower in the entity. We're going to go through the benefits and the downsides of this sort of as we go through it. But one of the downfalls is that you can't use negative gearing. So your borrowing capacity is going to be slightly lower there. But if with that, you look at Trust One, from day one, it's not going to be able to meet its own commitments. But within a couple of years, potentially with a little bit of debt pay down or rental going up as it does over time, you'll then be able to see that over a sort of medium time frame that property is then able to service itself. So that's when that long-term plan comes in place. Say Trust One is maxed out at, say 800,000. They've bought a couple of properties in regional New South Wales. Property Trust number 2 is then set up. Property Trust 1, there's a letter to make sure that it is all self-sufficient. They've then saved another deposit or potentially drawn equity where they can go on and start Trust number 2, accumulate 1 or 2 properties there. And it may be that they have, 3, 4, 5 trusts set up over the long term with the plan that, Trust 1 and 2 and potentially 3 is all liquidated later down the track to then pay down the debts on the other ones, leaving with that income stream. So you find that it's not from day one that they will be able to get that letter. If they do, probably looking at, a smaller regional property with a pretty high yield, because a lot of the properties that you find that we pick up will be negative geared from the start, which means that their costs outweigh their income. But getting into sort of year 2, 3, 4, 5, as the rental income goes up, expenses are sort of capped or potentially go down if they are paying principal and interest at the start. Flick the switch to interest only to reduce their outgoings. That's then the point that we can start getting those letters going.
Lovely. I've probably got 3 or 4 different questions off the back of that. One from a lending point of view, but also holding it inside a trust, something that you have to be aware of to account for your expenses is land tax. It's not always spoken about, but inside, if you do have it in a non-trading trust, land tax, you've got a threshold in each individual state. If you hold those property in your own personal name, if you put it inside a trust structure, that land tax goes to zero. So on the first dollar of the land value, you will be paying land tax on that each and every year. So it's a cost that you've got to work out when you're going through a long-term plan. What are my expenses going to be? When does this start to become neutrally and or positively geared? How much money do I have to put into it? And then if my goal is to have 5 properties paid off, Goldilocks scenario, and we want to accumulate 15, what does that look like, and lay it all out so that we can start to target the exact properties that we're after in the exact locations and start to build wealth for ourselves. But it's always the long-term planning is critical and key to make sure you've got great partners around you. Jared, you mentioned from a lending perspective that lenders will add in a buffer there as well. If you are doing lending through an entity, is the interest rates the same as your personal name or are they different?
Well, quite often it'll be looked at like an investment loan, which is slightly higher. You won't be able to do your owner occupied loan with majority of lenders in a trust. You may see a slight increase in your interest rate, but it'd be in line with what you'd be paying through a normal investment loan. So that's probably not one of the cost increases that would probably turn somebody off that is an investor. That would only really apply to the person that's buying that property for the purpose of asset protection for the family home, where they couldn't then potentially get an owner-occupied home loan rate because they are living in it as their principal place of residence. But that's probably a whole different conversation for another day as to why you do your principal place of residence in an entity.
Yeah. It's funny. I've been asked that question a couple of times recently as well. So we might have to do a separate podcast on that.
Yep.
On if that was the way that you went about it. Yes, you're probably going to pay a little bit higher rate, but asset protection from a director's point of view, or if you are running a business at the moment, I know it's big, so that you've got your own trading entity in whatever it is. It might be in mining, it might be in IT services, it can be in anything. The asset protection piece, especially if you're going to use and leverage yourself and go into property, is important, I believe, in something that I talk through with clients, making sure that if something ever went bad in your trading entity, you don't want your assets built up in that individual trading entity, because liquidators and or solicitors can come for all assets inside that trading entity. Therefore, the family or the protection for you and your family comes from not having assets in your trading entity, and that's what we're talking about with a non-trading entity, whether that be a company and or a trust. You can continue to build wealth in your trading entity, in your, let's call it carpentry business. You can then go and build your wealth in the non-trading entity, distribute profits between the two, and that's where you can start to build longer term wealth in an asset protection play, so that you can keep more of your money. And then it also becomes something I love talking through with clients is intergenerational wealth, because the beneficiaries on those non-trading entities don't only have to be you, they can be family members as well and or children, and it can pass through with great advice from solicitors, pass through to, you know, children as well. So that intergenerational wealth, when we start to do accumulate a lot, because if you do have 5 properties that are paid off, the average house today in New South Wales is, don't quote the figure, but it's probably in anywhere between sort of $700,000 and $800,000. Means you've got $4 million in assets. It's a large number of assets that I think that a lot of people would like protected for their family so that it can be passed down through the generations in the most effective way possible. Key benefit of a non-trading entity and having the right advice. Is there anything else that you would need to look at, or something that you do when you're talking through these scenarios with a client, non-trading entities? I know we spoke through making sure that you've got a good accountant, long-term planning, a little bit higher interest rates. We've got the land rates as well, or land tax that you would have to pay. Is there anything that you specifically talk through around a non-trading entity that you think someone should be clear on if they were thinking about this strategy?
Well, another thing to factor in is like, what's your end goal out of this? And if it is something that you do want to derive an income from, what are the tax benefits there? And is that something that you've spoken to your accountant about? The ability to have a non-trading entity and the ability to distribute income to beneficiaries, to children, to potentially lower the director's taxable income is another massive benefit. So to make sure they've done that adequate planning with their accountant is super important.
Or maybe financial advisor.
Maybe they're financial advisor.
That's something that I'll talk through, obviously, with a lot of clients is, yes, we've got the net benefit of what you want to do long-term, building wealth, but from an after-tax perspective, what's going to be the best position, or what's going to be the best place for you to build wealth from an after-tax perspective? So non-trading trust, yes, you still get all the benefits of the capital gains discount of, you know, if you've held the property longer than 12 months, you get a 50% discount. If then you do liquidate that asset and you sell it and there's a capital gains to be paid, that capital gain can then be distributed out to beneficiaries. So if you're a business owner and you're in the construction industry and your income is already $120,000, but your wife may not be working, she might only be on $40,000 or $50,000. You could distribute $70,000 worth of that capital gain to your wife so that you're both in the same tax bracket then. There may also be other beneficiaries, and a lovely beneficiary that I love working through out of a trust structure is also a company or a special purpose vehicle. So distribute that to the company and it pays the tax rate of a company of the maximum 30 cents in the dollar, which may be lower than yours if you're in the highest marginal tax bracket already, because your wage from your business is paying you, you might be paying tax at 47 cents in the dollar. So already you've got a 17% gain there by distributing assets, or having the ability to distribute assets when you do sell to the right people so that you can minimise your tax obligations. That compared to your own name, you don't have that ability. You just cop the tax. If you've got a house or a property in your own name and you sell it, it's 100%. And your income's already $150,000 and you've got a $150,000 gain to be paid. Your income for the year is $300,000. So anything above $190,000, you're paying 47 cents in the dollar, 45 plus 2% Medicare levy. So 47 cents in the dollar. So you may as well just work for the government from January to July. No one really likes doing that. That's essentially what can happen if you don't have the right structures and entities set up.
What do you feel about the costs that are involved here, and how would you sort of outlay them to your prospective client that comes in to see you and says, Kerrod, heard about this on the podcast, want to have a talk to you about it. This is part of our goals. We want to know what sort of other costs there are involved. You know, we've heard about setting up entities. We've heard about the different tax returns we've got to do. We've heard about land tax. Can you summarise for it and give us a bit of an insight so we can weigh up the pros and cons here?
Yep. Those are the biggest ones that you just mentioned there. You'll obviously have financials that need to be done each and every year. So that's going to come with accounting fees. Hopefully you've got a great accountant that can work with you on those. So you'll have each and every year, there's got to be similar to yourself, tax returns done for those entities. If it is a non-trading trust, you'll have land tax from the first dollar. And also, if there's any administration fees, if you've got a corporate trustee structure, which is another separate company, that we're getting into a lot of entities here, but you've essentially got accounting fees that you will need to get done plus land tax. So there are expenses that are cumulative that you have to work out to make sure it's going to be the best situation and scenario for you. So that's when you really delve into the client, what are they trying to do and where are they trying to get to?
Exactly.
If they're never going to sell them, well, it may not be the best option, or it may be the best option. It's when we break it all down, where is their income? Is that income likely to continue? Are they going to stop in 5 or 10 years and their income goes to zero? Do they need any additional income? Do they want to continue borrowing? There's basically on a whiteboard, I'm a very visual person. So where are you now? Where do you need to be? And what do you need to live off for you and the rest of your life, for you and your family? And then we just work back from there and make sure that we've got it in the most tax effective structure. That might be in your personal name when we're considering all the costs, might be in a non-trading entity, or it could be, in a family trust or a special purpose vehicle, special purpose company, whichever's going to work best for you. Everybody's different. It's hard to say. But especially working with business owners, when you've got the ability to distribute profit, not only to yourself, but to a family, it can be quite beneficial either to the family or to a company structure, because your income for the year might have a cracking year. If you didn't have these structures set up for you, if you had rental income, if you just held property in your own name and it was positively geared, and you already had $10,000 or $15,000 coming in each year, $200 or $300 a week, it's not bad. It's a great spot to be in. But if what you do for work, if you have a cracking year that year, you don't have the right structure set up, and let's say that you've got an income of $500,000 or $600,000 for the year, well then your $10,000 or $15,000 that you get, you just wipe half that in tax because you've got additional tax to pay. So there's $5,000 or $7,500, and you go, well, that's a cost too that you've got to consider each year. So how you're personally structured, obviously we're in Newcastle, there's a lot of coal miners around this area too that have got great income, so they're generally pretty close to the highest marginal tax bracket. Everybody's different. So I like to go through a whiteboard. What are you after? What do you do? In what time frame? And then we just work back from there.
There's costs of accounting and land tax, but there's also the cost of opportunity and the cost of tax for not planning. So I think it's very much part of that medium to long-term strategy. But again, different depending on the personal circumstances, because you might have mum and dad that in order for them to pass the sleep at night test, they're never going to go past a couple of properties. So in that instance, the extra accounting and that sort of thing may not necessarily make sense to them because they're never going to hit their cap. Their personal structure is fine, but that's where sort of coming in and sitting down, having a chat and learning what that looks like for each individual person is super, super important in that planning aspect.
Absolutely. Not everybody wants to have 15 properties. Probably nor should they. But if you do, and that's your goal to have 5 properties paid off, well, okay, then we need to have a look at what your tax perspective is going to look like. Because in that end scenario where you do have 5 properties paid off, it's going to produce rental income of, let's call it $100,000, $120,000. You've got tax to pay each and every year for the rest of your life to get that money out. If it is held in your personal name, it means tax returns each and every year. Is there a better option for you to hold that money? Potentially, yes. That's something that you've got to factor in and go, our end goal is 5 properties. That's going to produce $3,000 a week income. It's $150,000 worth of tax that we need to pay each and every year. What's going to be the best for you?
I've actually recently done this where we've changed around someone's objectives and goals changed from when I met them over the last sort of couple of years. We've transitioned probably 6 properties now into a couple of trusts. That'd actually be super interesting to talk about this. So
I'll have to get them on.
I'll reach out to them and have a chat, because that's where it's interesting that things do change and objectives change down the track, and it'd be interesting to go over sort of costs and things paid versus goals and capacity unlocked as part of that, and sort of what that's done for them. So
perfect. Let them know. Next Tuesday at 11 o'clock, we're on.
Well, I reckon that's entities in a nutshell. Now, really good to go over that as a sort of a general overview, pretty powerful. But obviously there's a lot in there. It's not all DIY. There's a super important team that you've got to build around yourself. So that's probably the most important thing that I can say as part of this, is that get your team together and get them working together. You want to sort of sub out and sort of sit and watch them work based on your objectives and your individual discussions with them. I think that's where you're going to get the best results, when they're all working together.
Team structure, working together is critical for when you are operating, especially through entities, because time kills deals. having everyone on the same page, aligning with what your goals are, is really beneficial.
Absolutely. Thanks for tuning in to Your Wealth Playbook. Reach out with any questions. We'll see you on the next episode.